There you have it, your closing bell for April 25th there. As we see, the major indices did manage to claw back and hang into the green just barely, just fractionally there. We're seeing the Dow up about 0.7%, up 240 points. The S&P 500 up over just about 0.2% there, 0.58%, up 24 points there. And of course, the NASDAQ there, the biggest winner of the day. Usually it's the one that takes the biggest beating, but today it's up 1.33%. That's up 165 points. Well, let's break some of this down between Dave, Brad, and I, as well as our market panel. Let's bring in Kristina Hooper, Invesco's Chief Global Market Strategist, and Scott Ladner, Horizon Investments Chief Investment Officer. So, Kristina, I want to start with you. What do you think the markets are digesting right now that really caused this turnaround?
Well, I think markets are recognizing that perhaps the things that they have been worried about aren't that bad. And that, in fact, what we saw today was investors and stocks climbing a wall of worry. Yes, the Fed is talking tougher, but that could be good, because if the Fed can do some of the heavy lifting with words rather than actions later this year, that actually could be a positive, especially in terms of shaping consumer views on inflation. So I think what we saw today was just a bit of a reprieve as investors digested what they were worried about and recognized perhaps it's not as big a concern.
And Scott, really the same question to you. It was a bloody Friday and looked like it was going to be that type of Monday early on before a bit of a rally. What are you seeing, generally speaking? Yeah, look, I generally agree with Kristina. I mean, today was pretty classically a growth scare day. We entered today with headlines coming out of China that they're locking down Shanghai. So everybody's worried about Beijing next, and worried about supply chains, worried about all the things that go along with this blatantly ridiculous COVID zero policy they've got over there. That is just self-inflicting wounds on their own economy. But it does impact global growth. China is still the second biggest economy in the world, and what they do matters from a policy standpoint. And so really the only thing that changed between like late last week and this week and today was the additional lockdowns in China. But that wasn't really a change. I mean, that's not fundamentally different than what has been going on over in China. So, policy-wise, nothing really shifted overnight. And so, I agree with Kristina. Like, people are starting to recognize that maybe some of the facts on the ground aren't quite as dire as they appear to be, because the Fed has turned to be the most hawkish institution in the entire world, and definitely the most hawkish they've been in almost 30 years. And the market is doing a lot of the heavy lifting for them already. And we've seen what's happened with tier rates. We've seen what's happened with the interest rate complex, broadly speaking. A lot of this is in the price. And so, the story today was, initially in the morning, hey, listen, we're really worried about China. We think there's some new information. We're worried about global growth, and the markets were pretty classically pricing that. But as we got through the day and we got a little bit more information and people kind of caught their breath, the market started to rebound, and the things that started to do a little bit better were the ones that got beaten up the most. And so that is kind of classically also buying the dip sort of activity. Certainly. And so as we were looking at the levels that we struck earlier today and then ultimately saw some on the latter half of the trading session, significant up volume outweighing that down volume that had really permeated since Friday as well. Is it too early to call this a bottom, or is it safe right now to call it a bottom, considering the number of people that entered into the tape, Kristina?
I think it's too early to call it a bottom. I think what we are going to see is continued volatility over really the next several months as markets adjust to this more hawkish Fed, and as the Fed starts to raise rates, probably by 50 basis points at the next several meetings. That's okay, but that is going to create volatility, ups and downs. And so I think it's very difficult at this stage to call a market bottom, although I do believe we will see a market bottom this year.
And Scott, then how are you advising clients then in terms of the signals to watch versus the noise to ignore, as we do have this more hawkish Fed and we do still obviously have some of these geopolitical concerns, whether it's Ukraine or perhaps the additional pressure we might see on supply chains from the outbreaks in China?
I mean, that is a really, really important question, Rochelle, because the macro backdrop right now, the amount of noise that's in the system is incredible. And this is a really, really complex macro backdrop, probably the toughest one in my 25-year career to really untangle and figure out, because there's a lot of macro headwinds out there, and they're very well known. Everything from the Fed to China to COVID to inflationary pressures that we haven't seen in a couple of generations. All the macro sort of headwinds are pretty well known. The thing that's not very well known right now, though, is I think is a little bit underappreciated, are some of the micro tailwinds that we do have behind this market right now, specifically U.S. company earnings, corporate earnings. They are starting to come in pretty well, with the notable exception of Netflix. Everything else is coming in pretty strong. You guys mentioned Coca-Cola earlier today. We're looking for earnings really this week and next week to come in pretty strong on the back of, frankly, very strong consumer spending and a very strong consumer behavior that we're starting to see. We all know sentiment is in the toilet, and it's like people feel terrible about things right now. But that is not how they're acting. It's not how they're behaving. It's not how they're spending. And ultimately, it's that spending that's going to drive corporate earnings to be pretty much okay this quarter, and probably looking a little bit to the upside throughout the rest of the year.
But with the amount of that is gas and spending more on just energy and being able to function operationally as a household and get around necessarily, X that, is the spending truly high right now, or is it just relatively high because of the prices year over year and the comparison there?
It's a great question. So, one thing you can do to look at disentangle a question like that is look at unit volumes and rather than actual sort of the dollars amount that's being spent. If you look at unit volumes, things are still moving pretty well. But it's harder unit volumes when we're talking about units of fun. And what people are spending on right now is really units of fun. They're going to concerts, they're booking restaurants, they're booking trips, they're booking airlines. Like if you look at airline bookings, if you try to get a table at a restaurant on a Saturday, if you try to do that on Thursday, good luck. It is, people are spending money on fun stuff right now because of the dearth of fun they've been allowed to have for the last couple of years. And so really it's that kind of spending that we're really watching. And so, you do need to look at it in real terms. Nominal terms is a little bit misleading. But if we're looking at services spending, we need to bifurcate it out in more real terms rather than nominal terms. If we're looking at goods spending, you can look at unit volumes, and those are showing the same kind of pattern. The spending is holding up relatively well, especially against the backdrop of what everybody is saying, like the consumers are so depressed and they're in a horrible mood, which generally speaking they are. But their actions aren't matching what their mood is right now, and that's the important point.
Extraordinary resilient, in particular with travel. I mean, it's just baffling how people continue to spend. Kristina, I want to get to you. You talk about a lot of the major geopolitical events. We discussed the lockdowns which continue to spread across China, the Russian invasion of Ukraine, but not talked about as much is Emmanuel Macron winning re-election. Marine Le Pen loses, but seeing her influence gain there in France. What are the economic implications?
Well, for right now, we are going to see volatility go down. Markets certainly were nervous about some kind of extreme change in French leadership and the potential for geopolitical ripples. That is not going to happen. But Macron has worked over the last few years on economic reform. That's really been a centerpiece of his platform. That was very easy because he had a legislative body that was behind him, that was of the same party. That comes into question in June when there are elections that will determine the future and whether or not he will have that majority support or whether he will need to essentially do less and give up more to other more extreme parties on both the right and the left. So for now, this is certainly a positive situation. It's what has been priced in over the last few days. But there certainly is the potential that Macron could enter his second term without that kind of support that he had in his first term, which would make economic reform harder, but would certainly not stop him from his loftier goals in terms of more unity for the European Union, strength of the euro, things like that. That certainly can still be achieved, regardless of whether or not he has a legislative body behind him.
And Scott, as we look at some of the international issues, we have seen that demand in China has been falling when it comes to oil, which, as we saw, brought oil prices down today. As you look ahead then, and we look at things like inflation, what are you going to be keeping an eye on longer term this year?
Really a couple of things.
Sorry, go ahead.
Sorry, that question for Scott.
Okay, sorry. We can both talk, I'm sure, a lot about this because that's a deep and very interesting question. Look, as far as inflation expectations, as far as things we're looking at, there are a couple of that are a little bit under the radar, I'd say, that might be a little bit interesting to the listeners. One of them is actually what forward inflation swaps are pricing at. So what are derivatives markets actually pricing for 1 year inflation 2 years ahead? So basically, what does 2025 inflation look like? And is that getting out of hand? Right now, we can say pretty definitively that it's not getting out of hand. People are expecting, inflation in 2025 to be about 2.75% to 3%, which is certainly higher than what the Fed wants, but it is not like the 6, 7, 8% inflation readings that we're seeing right now. So in terms of expectations getting de-anchored, we're not seeing that. So that's something that we're watching fairly carefully, but we've not seen any evidence of that happening yet. The other thing that we're looking at is actually in the interest rate volatility markets. A 6-month option on a 2-year interest rate versus a 6-month option on a 10-year interest rate. Typically, the option on the 10-year interest rate is much more volatile and it's much more expensive because that incorporates not only Fed policy but also growth in inflation expectations. And so there's basically a lot that goes into a 10-year rate. But the interest rate option on a 2-year rate really is just like how volatile is the Fed expectation is going to be. It's really just an option on the Fed. And right now, that option on the 2-year rate is more expensive than the option on the 10-year rate. What that's telling us is that the market is really, really confused about what the Fed is doing. They're really confused about how active they're being and kind of what the course looks like. That's not helpful for the Fed, either when they're fighting today's problem, which is inflation, or tomorrow's problem, frankly, which is going to be growth. And so, the two things that we're looking at to try to figure out, is the Fed being, maintaining credibility and also getting a little bit more clarity in terms of their message, right, is what are the options looking like for those 2 and 10-year rates, in terms of the relative prices, and also, that 2025 expectation, French, that 2025 expectation, is that staying anchored? Is that staying below 3%? And if that remains the case, then we think we're probably going to be fine.
All right, but unfortunately, we will have to leave it there. But we're looking forward to getting you both back. Kristina Hooper there, Invesco Chief Global Market Strategist, and Scott Ladner, Horizon Investments Chief Investment Officer. Thank you both for joining us today.